You are most welcome to this seminar today. It's a special seminar on the interbank market. Interbank market in Sub-Saharan Africa. We are delighted today to have a group of people from central banks around Africa who have been working with us as part of a research project on delivering inclusive financial development and growth. And one of the work packages was on the interbank market. So as part of this project, we were able to undertake the first ever studies or research on the interbank market in Sub-Saharan Africa. And I'm delighted that our colleagues will be joining us from these central banks. I'll introduce them after this presentation. So what I thought we would do is just start with a general broad presentation on interbank markets in Sub-Saharan Africa. And then we will be able to proceed into getting sharing experiences and policy and other insights from the respective central banks. So the presentation will be in those three parts of the activities this afternoon. Okay. Let me start by sharing with you a couple of papers just to excite your interest in case you want to look further into this issue of interbank markets in Africa. And here, what I'm sharing with you is quite a couple of papers that started off this research, which are relevant to the points I'm going to cover on the interbank market in Africa. The first here is a paper by a couple of people, Chris Green at Loughborough, by at Xiantong University in China, myself, Keith Ngoka at Central Bank of Kenya, Mana Isaya, same Central Bank of Kenya, and Tiriongo Sammy, Central Bank of Kenya, now Kenya Bank Association, who will be talking to us later. And here we did a most comprehensive survey on overnight interbank market rates and the determination of how the interest rate in the interbank market is determined. We surveyed all industrial and emerging countries around the world. We cover the theory and the current models that are used to study the interbank market, and we introduce our own models, and then generate the research questions that we investigate in the research project funded by ESRC and FCDO. But also there is a paper that gives really the structure. This is the first documentation ever of the development of the Kenyan overnight interbank market, and done by the same group and published in a book that came out in 2018 on financing innovation and sustainable development in Africa by Muna Dulo at Cornell University in the US, and Stephen Kaizi Mugerwa, who was by that time the chief economist of the African Development Bank. And then we put all these studies in the context of financial development and economic growth in Africa, drawing from an earlier paper that I had published in the Journal of African Economies. The technical report of the work area funded by the World Bank is just also cited here, given for the Central Bank of Kenya. And then also an interesting studies, one say by Esmie Kanyumbu, who works in the interbank market section of the Reserve Bank of Malawi, which is the Central Bank of Malawi. And Esmie will be speaking to us later today after my presentation on her research and experiences as a policymaker and practitioner. There is also a new survey paper of interbank lending networks by Anosi, Ikimalo, and myself, which is in a working paper session. Anosi will be speaking to us later on about the theoretical models that he's developing and the empirical part of the work that he's developing also, and about further research here at Center for Global Finance at SOAS. And also I include here, mention a paper by Dr. Thomas Bwire and his colleagues, Martin Brownbridge, Doreen Rubasimbila, and Grace Tinyinodi at the Bank of Uganda. And they did, as part of our project here, they did a wonderful study on looking at the institutional environment and how the interbank market structured in Uganda with all the banks. I generated 2 working papers, and these are the working papers cited here, and also which are on the CGF working papers, including looking into the interbank market interest rate and the soundness or stability of the borrowing banks. We are fortunate that Dr. Thomas Bwire will be speaking to us later after my presentation. And then we also have an interesting paper by Dr. Francis Mbao, Lungu, Sheila Makoni, Azurubaya, Kosam Chanda, and yes, there should be Dr. Jonathan Chipimo from the Central Bank of Zambia, and Jonathan, Francis, and Kosa will be speaking to us later after my presentation. And then we have another paper that looked into a legislation component of interbank market, which again were done by myself and a couple of our colleagues I've already mentioned, which look into the peer monitoring rule. And this is now on revise and resubmit in a major journal, but appears also on the CGF working paper. So there's quite a number of papers. I thought I should mention these because they are readily available in the public domain. And if I have not covered something in great detail, or we don't have time to cover it, it would be exciting maybe to go and have a look at these papers. So let me then start by positioning where interbank markets come in. We know very well that the financial system in Sub-Saharan Africa are dominated by a mixture of traditional banks. This is mainly in urban areas, and there is some high degree of informal finance, mainly in rural areas, lending and borrowing among family friends, borrowing and lending among informal associations. So we see that really the financial systems in Africa feature a limited range of financial instruments in the flow of funds, limited number of asset vehicles, limited number of liability vehicles. So some of the vehicles you would get, say, in the UK economy, you may not be able to get, of course, in these countries in Africa. So we could argue there is a lack of breadth, especially in terms of a limited number of financial markets and instruments, and also lack of depth or opportunities in which investors may trade assets in secondary markets, an observation that Aren and others fronted out in 2011 in the Journal of African Economies. But if we fast forward from this current situation or the status quo, and we try to look to, say, 10 years from now, where shall we be? Would expect that there will be five major changes. The landscape certainly would have moved. and especially that in 10 years from now in Sub-Saharan Africa, we'll have a high degree of provision of transactions, payment services being able to be delivered, a high volume of liquidity, number three, a high assortment selection of saving facilities. And through these facilities, we can reward savers and also enable the pooling of savings to facilitate investment projects. Of course, the correlation of saving investment taken into account. And also, fourthly, that there would be vehicles for information sharing, okay, the bureaus, the information and data exchange for screening and monitoring of savings and investment projects. And because of that high degree of information availability, also the opportunity for risk sharing and risk management, and especially through secondary trading and insurance. And therefore, this would happen because when we fast forward 10 years from now, let's say 2030, we would be riding there because of three new mega developments in Sub-Saharan Africa. The first is what we are looking at today, the attempt to strengthen the interbank markets. That comes at the core, that the interbank markets revolves and make sure the flow of funds, and that strengthening will enable some of these developments to happen. But that cannot be the lone factor. The other important factor is the current growth of Pan-African cross-border banks. And we shall have a seminar on this topic in the near future to show how a new breed of banks, which was not there, say, 20 years ago, have come up and they are highly competitive. They started as small micro savings, and over in a short period of time, it has been possible for these banks to expand from one country to another across countries in Africa, and also to even establish branches in industrial countries of the world. Which are these Pan-African banks that go cross-border? It's a very important development, and we shall cover it in another seminar. The third factor that will drive the developments in the financial system in Africa is, of course, the Fintech Revolution, the digital revolution, and the ability to kind of innovate and generate new financial instruments that can fund businesses and also the demand by households. And so in this lecture, in this seminar, we focus on the first dimension of strengthening the interbank markets. We have had another seminar recently on the Fintech Revolution, and we'll have another seminar in the near future this year that looks at Pan-African cross-border banks. Okay, so let's look into interbank markets. These interbank markets basically are playing a role as a group of secondary markets to provide critical facilities for the banking systems to manage, pool, and redistribute assets and liabilities within the economy. So in the flow of funds sense, you have banks providing the usual lending, borrowing, especially high street banks or retail banks operating independently, but also together, and being able to clear their balances among themselves, settle balances among themselves, to borrow or lend among each other overnight. And this is the emergence of the overnight interbank market, and arguably the most important of all the interbank markets. In fact, if you can borrow a leaf from the industrial economies like the UK, you will note that globally in the UK, US, and other G20 countries, it was the freezing of the interbank market and related short-term lending that really created the onset of the 2008 and 2009 global financial crisis. And one of our co-authors, Chris Green, has mentioned this in the paper that is entitled When the Music Died. And the core market for that required quick policy moves to restore trust and confidence in the financial system was actually to deal with defreezing the interbank market. And that's how important the interbank market is. But how does it work, the overnight interbank market? Banks, say if you take banks, say in the UK, Barclays, NatWest, and others. And so banks in Sub-Saharan Africa, which are the dominant sector, they undertake transactions for clients, for us, households, also for businesses. And because businesses and households bank across a number of banks, there is need for these banks to do settlements and payments among themselves, undertake the correction mechanism. In this process, some banks may be short of cash to balance their positions at the end of each day. And if they are, then they can be able to draw upon the liquidity of other banks. But actually, the banks which fall short of cash at the end of the day, they have two main options. One, they may run to the central bank, so they may borrow from the central bank. Or two, they may borrow from the overnight interbank market. Or three, they may borrow from both, take 60% from the central bank and 40%, say, from the overnight interbank market. What is important in the institutional design of interbank markets globally and Sub-Saharan Africa are three main ingredients. Okay. One is that the transactions within the interbank market are based on trust, the confidence and the peer trust among the peers. Second, because of that trust, there may not be any collateral to safeguard the borrowing, because the banks are monitoring each other's transactions. And three, there may not be any intervention from the central bank. In some countries, you may find some variation that maybe collateral is introduced on and off, but not the majority, and maybe there is intervention. But the key central ingredient here of the institutional design is trust. That there is a high degree of trust among the banks. They are peer, they are lending and borrowing among peers, and the peer maker, and therefore they are operating mainly on the basis of trust. If there is any risk, they price their risk by actually varying the interest rate changed. Okay. So, and sometimes they may not go to the central bank at all. In fact, borrowing from the central bank is usually regarded as last resort borrowing, just as in the connotation of the central bank being a lender of last resort. And it may involve a penalty cost. This is a premium over and above the cost of borrowing from the interbank market. So if the cost of borrowing from the from the interbank market is 2%, maybe if you borrow from the central bank, you pay 2.5%. Okay, and I'm going to show this in a moment in one of the charts. So in this context, borrowing on the overnight interbank market is the next to last result, not last result, but next to last result. So, and this enables that banks with the excess cash reserves during the day can be able to have immediate outlet for those reserves by lending into other banks on the overnight market. And it is in that context that we argue throughout the papers in this project that interbank markets are among the most crucial group of secondary markets, which needs to be strengthened to be able to grow the financial systems in Sub-Saharan Africa over time. Of course, the interbank market has other implications. And for Sub-Saharan Africa, the overnight interbank market has two main implications. One is for monetary policy, the other is for policy regulation. And that is why policymakers, including those that will be speaking to you today, have a keen interest in the interbank market. But let me first explain the overnight interbank market and monetary policy. The market interest rate on overnight loans acts as the fulcrum of monetary policy. The interest rate formed in the interbank market works as a pivot of monetary policy regime in that country. And this is why in some countries, the overnight interbank market rate is regarded as an operational target for monetary policy. So monetary policy changes by looking at this target, monitoring and evaluating the movements in the interbank market rate as an operational target. Okay. And also, in that context, the interbank market rate acts as the anchor of all other interest rates in the economy. So it's anchor of the term structure of interest rates, other interest rates for different periods, 24-hour lending, 3 months lending, 6 months lending, and 9 months lending. I should draw a parallel with the London markets or the global markets would be the LIBOR, the London Interbank Offered Rate, that basically also acts as a signal anchor for many other interest rates. So we could argue that this overnight rate links the interbank market with the transmission mechanism of monetary policy. The changes introduced the interbank market, the data changes, which we call the market microstructure and price discovery, which are the changes in the interest rate in the interbank market. On a daily basis, they ripple out and signals for what happens in liquidity flows among the banks operating the interbank market. For this matter, it's very important to understand the interbank market and mainly to investigate the determinants and the dynamics of the interbank market, what really drives the interbank market rate, okay, and how this would be like to unfold a monetary policy in vogue in the country. Now, just wanted to I draw this from our work on Kenya, and in this chart, just to highlight here what you have in black here, this line here is the Central Bank of Kenya discount rates. So banks who have shortfalls on a daily basis are able to go to the central bank and borrow at this rate. So at this time, for example, it was 10% and it moved on. As you can see, it has step changes as you go because it's not market driven. It's a step change. It's response to policy. Policymakers change that rate. So that's why it's a step change. And then you have other interest rates. For example, the annual interest rate on 91-day treasury bills, that's a market determined rate. In green, that is moving up continuously, but you see all the time below the Central Bank of Kenya discount rate. And then you have the difference between the interbank market rate and the treasury bill rate. That's the spread. And this spread here is in red here. And you can see the spread here is also showing the hovering below the discount rate. So this rate is so important, but basically we're evaluating it with respect to the other options that banks have when they have a shortfall in the interbank market, i.e. to go either to the central bank or to go to the interbank market. We're knowing that if you go to the central bank, they will pay a penalty. They'll get a higher rate, which is the interbank market rate plus a certain premium, lambda, for example. But there is another reason. This is another reason why commercial banks will hesitate to go to the central bank to the discount window of the central bank. That's because it may be a signal if the bank is persistently running to the discount window on a daily basis, and the central bank is the regulator, it might signal that this bank is having a lot of shortfalls, and the supervisor might be knocking on the door of this commercial bank in attempt from there. So it may give a different signal in terms of the information relayed. Okay, and here we just want to see how the interbank market spreads, for example, are related to the central bank support and also to reserve management of the central bank in terms of how to deal with excess reserves. Okay, what we see here, that the interbank market is used for mopping up liquidity from those banks or those banks that tend to show high liquidity. Okay, and the spread of given the discount rate minus the weighted interbank market rate, okay, is here given on this spread, and actually the spread is going up, all the time. And basically, as long as this market is active, okay, and the spread between the treasury bill and the interbank market is much lower, then you do find that actually there is no much excess reserves. The excess reserves build up later here, let's say in the later period, when there is when the two tend actually to run together. In other words, the interbank market and the central bank rate are closer. But an interesting aspect, of course, is how the interbank market rate, developments of the interbank market rate, relates to the treasury bill rate. As in the interbank market rate, we are looking at the trading by banks among themselves on a daily basis. And also we then compared, for example, the treasury bill rate, whereby the banks may use long-term or medium-term, financial instruments, and this is weighted against the central bank discount rate, the movements in the central bank discount rate over time. Okay, and the interest rate, which is a mean, the nominal interest rate charges. Every bank has an interest rate, okay, on different financial instruments. And if you get the mean interest rate, it's an indicator of the cost of borrowing in the banking sector in that economy. And that's the one that is given here by the red interest in that curve given in red, over time. And the fact that basically the interbank rate also is fluctuating, but is actually almost looking like mean reverting, irrespective of the other changes. And that shows the efficiency of the interbank market in its operations. As I mentioned, the interbank market, the implication of interbank market in Africa could relate to monetary policy, that is, changes in the interbank market interest rate compared to other interest rates in the economy, and how this is used to regulate liquidity, the availability of liquidity for banks which have a shortfall and banks which have more liquid actually to be able to lend. That, in essence, is the monetary policy component. But the other implication I mentioned briefly at the start of this seminar is that the interbank market has important implications for bank regulation. Okay. Bank regulation, formal bank regulation, is in Africa driven by the changes in the Basel Accord. In most countries now in Africa, they are on Basel III. Others are still hovering between Basel II going to Basel III, and that's the official regulation that tends to regulate the cash requirements on a daily basis and the activities of the commercial bank, both on the balance sheet and also off-balance sheet activities, for example, including other forms of trading in foreign exchange and in other instruments. But that is official regulation, official bank regulation, Basel III. It's important to bear in mind that the peer monitoring and the peer mechanism of banks among themselves works as a form of market discipline and therefore some implicit regulation or peer regulation of the banks among themselves. And that's the context in which we are looking at the interbank market as a sort of peer regulation. And there's three important questions here. For example, can the riskiness of banks be mitigated by peer interbank monitoring? And the question is basically, by being able to monitor themselves, on the basis of which they can lend among themselves in the interbank market, basing on trust, with no or limited collateral, with no or limited intervention of the central bank, meaning that the banks can be able to read the riskiness of other banks in the peer and lend to them, and lend those banks that require the cash. Okay. The other question we ask themselves, is there sufficient evidence of market discipline? And this is an empirical question that we did investigate to see whether market discipline is really the case in which banks are able to reduce risk because of the peer monitoring in the interbank market. And the third question is that what are the characteristics of the banks that are part of the peer monitoring and self-regulation mechanism? And we look at the nature of the banks, the size, the total assets and other parts of the bank characteristics. I should point out that this argument can cut both ways. Banks in the interbank market may, through a peer monitoring mechanism, impose strict market discipline among themselves and therefore reduce risk. That is one side. But it may also be argued on the other side that banks in the interbank market may collude. Okay. And if they collude, they may, for example, rig the interbank market interest rate. And in the case one bank fails, that may be the source of contagion. So the interbank market potentially could be a source, a source for the propagation of contagion and market risk. And this is the reason why in number 2, when we say sufficient evidence market, we actually are putting this question to empirical investigation with data to see whether the effect of the interbank market in a given economy are regulatory, supporting regulation, disciplining among peers, or whether it has, to some extent, provided some propagation of market risk. As you may know, in London, the Labour case, the London Interbank Offered Rate, there was a case of Labour, and this is one of the mechanisms where say banks may collude. Okay. We all these papers I mentioned carry a lot of evidence here. What I'm trying to do here is basically to summarize some of these evidence. What are the characteristics of these banks? Because the overriding evidence among these banks in Sub-Saharan Africa is that bank size matters. Okay. But beyond the bank size, or within the context of bank size, what are the main characteristics or main findings that we uncovered? The first is to look at our findings in context of the lending banks among the network of interbank market banks. And the lending banks show that the transactions volume is dominated by medium-sized banks. But the number of deals decrease with bank size. And the interest rates increase with bank size. So the bank size is an important consideration in the trading. And similar results tend to happen not only with the lending banks, but also with borrowing banks. But over time, when you look at the transactions, say for the last 10 years, we tend to uncover a pattern, which sometimes may be counterintuitive. The first is that the small banks are net lenders. And we of course expected that the big banks would be net lenders if they want liquidity, but actually the small banks are net lenders. The medium banks are also net lenders, but for some period. And that the patterns of interest rate margins are very difficult to pin down. The operation, as some of the colleagues may mention later, of the interbank market is based on networks. And some of the networks create unique structures, like banks operating at the core of the network and banks operating at the periphery of the network. But the most extensive relationships are small to medium, small and small banks, small and large. As you can see, what is missing here is medium and large. Okay. But overall, these banks trade mainly among their peers, and so there is some kind of herding behavior in this mechanism. The econometric evidence uncovers an inverse relationship between interbank market activity and bank risk levels, even when you control for all differences in bank characteristics. What does this mean? This means that the interbank market is potentially an effective market discipline device, which is one of the questions we looked at. And therefore, the policy implications are that the riskiness of the bank can be mitigated by the volume of interbank market trading. And this is to support the argument of market discipline. We also find that size matters in another context, because banks, large banks in the bank market seem to have lower risk levels. But as the size increases beyond a given threshold, it creates a U-curve effect. In a sense, the size disadvantage, diminishes. And that may be because after a certain size, the top largest banks tend to lie outside the peer monitoring device. And that size may be a disadvantage for them, but that the peer mechanism has got a certain type of limitations. We also get some information on the capital adequacy of these banks, participating banks, and that basically that the trading advantage that the interbank market provides a trading advantage. What I want to highlight just as we conclude is just some 6 main findings that have implications for policy and also for institutional setting of interbank markets, for example, in countries where this market is not yet strong or where it needs to be strengthened. We find that in some countries in Sub-Saharan Africa, the interbank market is already deep and liquid. And this was the case, for example, in Kenya. But I think more studies are required across the main markets and say across regional groups. There are about 6 regional groupings in Africa, and looking at those groupings would be very important as an area of further research. We're interested also to know and to find out what really drives the interbank market rate apart from the interbank market microstructure, the price discovery process during the trading. The other conditional factors, of course, the interest rates as part of the other transactions in the economy, the exchange rates, which of course influences, a money supply and other variables. The exchange rate is very important, open economies. And then there is just a group of supply demand factors. And in countries where this happens, central bank intervention may also be a big player in the determinant of the interbank market. Okay, the gamma for interbank market intervention may be zero. In some countries, in others, it may be a small fraction, but not normally more than 0.5. It is also one of the findings that intervention rates can play an important role in influencing interbank markets, especially where stability is a major issue in the economy. What about the peer market discipline? The general conclusion that, or takeaway we can get from these studies, that the interbank market peer discipline provides covert regulation in addition to the overt Basel III type of regulation of banks. And this is very important. In fact, one would extend this argument to say that while overt regulation, Basel-based, may play an important role, without looking at what happens in the interbank market as economies grow, would be a miscalculation. And so we generate the observation that interbank markets are among the most crucial group of secondary markets that policymakers and practitioners need to look into and strengthen in Sub-Saharan Africa as in the process of growing the economies. Much more importantly than the interbank market will be very crucial in the next 10 years because of the growth of Pan-African banks, Pan-African cross-border banks, and also because of the growth of the Fintech Revolution on the continent. Thank you very much. At this point, I would like to call upon the guest speakers who have been invited to speak on specific banks that are part of this project. May I start with Dr. Thomas Bwire, Bank of Uganda, and COMESA Monetary Institute, who has a double affiliation. So, Thomas, are you ready to share with us your views?
I think I should be.
Oh, thank you.
Ready. And thank you, Victor, for that elaborate discussion. In fact, you made my work very easy because I don't have to give the background information. And just to go there.
Yes, thank you. Yeah.
I think from what you have presented, I just want to mention that a key contribution to this kind of debate in this paper is what is it that drives the interbank interest rates? That's the fundamental question we are going to answer here. But possibly before we jump to that, of course, you have already introduced me. I don't have to introduce myself anymore. And the colleagues who are on the forum, you are very welcome. Some of you are very good people you have met with before. And it's a pleasure meeting you once again. Now, I think a few issues stand out loud from what you have discussed. That one, there is that element of liquidity insurance that is implicit within the interbank market. And also to add that on average, most of the dealings within the interbank market, that's the loans, are not collateralized. Now, And the operation is within a complex network of financial linkages. Now, when you look at this combination of issues, liquidity insurance, and then banks dealing in mostly incorrect transactions, it gives a very fertile ground for moral hazard. And once that steps in, we could see the element of excessive risk-taking by banks. And because so many banks are involved, then we could see contagion risks in the banking system being heightened. And we tend to think that it follows from this kind of scenario that Pillar 3 of the Basel II Accord then allots a very big role to the market to monitor and, of course, discipline risk-taking by these banks. Now, a fundamental question is, how does the market do this? And we do think that one possible channel through which this monitoring and, of course, discipline can occur is through the interest rates that the banks pay to borrow on the interbank market. A reason being that banks are in a very good understanding of the financial position of their counterparts, and because of that knowledge, which sometimes the regulator does not know, they should be in a position to price the risk that is entailed in interbank lending. So this is what forms the bag of the kind of work that you have run in the working papers there. And therefore, what we do is just to dig into that with actual hard data to find out what exactly derives these interbank interest rates. And we have a couple of variables that we have in mind. One of them is the financial soundness indicators of the borrowing banks. And then we also look at the structure of the banking system itself. By structure, we're looking at the size and then the ownership, as well as banker demand for funds on the market. Now, as Bank of Uganda, we are privileged to be receiving this banker level data on some frequent basis. So we use that data and then apply the usual panel regression analysis over the period Q4 2011 to Q1 2016 to do this kind of work. So that is the basic background of what this paper and what my discussion is going to be about. But possibly before I go into what we see, I'm not very sure I can move this very easily. Maybe Victor, you can help me. I saw you running through this.
Yes, click on.
Okay,
Yeah.
okay. I think I am there. Now,
Yes.
just to add some flesh, I think it's important to just share with you the Ugandan experience in terms of this interbank market, which then forms a precursor to the estimation and the kind of results maybe we are likely to be seeing very soon. I want to mention that in Uganda, the financial sector is dominated by commercial banks. In fact, about 83% of the total financial assets constitute the commercial banks. And given the period over which this study is done, we had 25 regulated commercial banks by December 2017. 19 of those had been in operation through the period 2011 Q4 to 2016 Q1. So that's the structure of the banks there. Now, in terms of participation in the interbank market, we have two general players. One are the commercial banks on one hand, and the two, we have the central bank, it's Bank of Uganda on the other. Now, Interestingly, the Ugandan interbank market is quite heterogeneous, and the banks are differentiated based on two things: ownership and the size. And I wish to speak to these two very briefly. That's ownership and size. Now, in terms of ownership, we differentiate our banks in terms of the country of origin of majority shareholders. And for that matter, we have global banks, we have regional banks, and we have domestic banks. Global banks are those whose origin is outside Africa, and we have 7 of those. And the regional banks are those whose origin is within Africa. Now, combining those two, I could mention that the origins of these banks are US, UK, we have India, we have Nigeria, we have South Africa, we have Kenya as the dominant players, and then we have about 3 domestic banks. Unfortunately, of the 3 domestic banks, one closed around early 2017. So by that time, at the time of this study, we were having about 2 domestic banks after one had been closed. Now, in terms of size, we define size in terms of the asset of the bank relative to the industry total. And these numbers are quoted as of December 2017. So we categorize banks into 3 categories based on size: as small, medium, and big. Small are those whose asset shares are less than 1% of the industry total. And looking at the whole spectrum of banks, about 11 of Ugandan banks fell in that category as of that date, commanding a market combined share of 8.1%. And we had medium-sized banks whose asset share fell between 1 and 7.5%. We had 10 banks in that category with a combined market share of about 42.5%. And then we had big banks whose asset share was in excess of 7.5%. And the 4 banks were in that category with a total market share of 49.4%. Okay, just to throw more light on a few things that are of interest to us. The first thing we want to investigate is the issue of bank concentration. How concentrated is the banking system in Uganda? So to be able to do that, we construct that chart where we are having a commercial bank asset sizes deviation from the industry average. And as you can see, beginning about here, this is when the deviation begins to become positive from the 16th bank. And counting to the right, we have about only 9 banks whose asset sizes are above the market or the industry average. And now, for example, to get the asset size of Bank 16, we would get the industry average, which is 884 billion Uganda shillings, and then we would add that 40 billion to get the size of that bank. But before this, all these ones, they are falling below the market average. So the concentration is by 9 banks, and these 9 banks command about 80.5% of the total industry asset. The good news, however, is that this market concentration has been on decline, falling from the 2006 levels to about 976 as of December 2017, using the Hafid Hegemon Index. So that's the first important feature about the kind of market that we're talking about. Number 2, I want to refer to the nature of the instruments that we see effectively on the interbank market. Like I mentioned before, the main instruments are unsecured interbank loans, and we have two of these, overnight and 7 days. Of course, with others, but of much less frequency. But of these, the overnight is the most dominant. Actually, it's about 90% of the trading on the interbank market. But what I want to point out from this chart is that if you look at, I don't know which color it is, but if you look at this, this is the overall trading on the market on in that particular year. And the one which is closer to it is the overnight, and the 7 day is the one in black. And the story is consistent all through. In fact, overnight has been increasing over time, with the decimal changes in the 7 day. And that's the reason I say that the overnight is the most dominant of these instruments on the interbank market. Now, despite of the dominance of the overnight, Victor did mention in his paper that the operating target for most central banks is the overnight. For the Bank of Uganda, it's not. Actually, the operating target is the 7 day. But of course, for some particular reason, the reason being that 7 day is more correlated with the other term structure of interest rates than it does the overnight, and therefore it presents a better medium for the transmission of monetary policy than it would be with the overnight. However, we are yet to check that. I don't know whether if we check that today, the story will be different, but that is something that can be done at some other time. Now, I want again to speak to market segmentation, because this is a very big elephant in this discussion. And to speak to market segmentation, what we see here are two tables, the one up and the one down. The one up is for overnight, and the one down is 7 days. So I will concentrate on the overnight, because we don't do much with 7 days. But what we do here is that we have the banker category, small, medium, and large. Then we have lending, borrowing, and then the deviation of the lending from the CBR, the deviation also of the borrowing rate from the CBR. So what story does it tell? Now, when you look at the column for lending, you discover that that the lending is quite consistent with the bank sizes. Large banks lend more, followed by medium, and small banks lend less. Okay, now, when we turn to borrowing, you discover that the dominant player on the interbank are medium-sized banks, borrowing to the tune of 61% of the total borrowings on the market. But what is much more interesting is that these medium-sized banks borrow more than they lend. Victor alluded to this. But also, when you turn to the large banks, you discover that actually they lend much more than they borrow. And there could be a reason for that. Possibly they have a liquidity surplus, and therefore they have a lot to lend, but less need to borrow. But the reasons behind that is what we investigate. Now, when we turn to the penalties, for example, small banks are charged more than any other category of banks to borrow on the interbank market. In fact, small banks borrow at about 1.1 and 1.9% over and above what the medium and large scale banks borrow, respectively. So some kind of penalty there. For reasons, again, we are yet to find out. Now, surprisingly, when it comes to lending, the small banks receive moderately more on what they lend out compared to what these other categories receive. So some bit of pack of information there that we need to unpack. What explains this? Now, before possibly we venture into what explains that, let's look at the interest rates by asset size category themselves. So what do we see? Here we have charges being, rates being charged by big size banks. And when you look at it, you find that small banks really pay through the nose. Okay? And also what is interesting is that the charges of big banks to fellow big banks is quite substantial. At some points, it's quite high, but it's not consistent also. And the medium-sized banks are somewhere in the middle there. Okay, what is the story with the medium-sized banks? We see that with medium-sized banks, they also charge small banks highly compared to any other category of banks. But of course, there is a lot of, you know, a lot of, I even don't know how to put that. We see that big banks, when they are borrowing from medium-sized banks, the charges are much, much lower than any other category of banks. Now, when you turn to the small-sized banks themselves, again, they penalize themselves much more than any other category of bank. And we see big banks, again, turning out to be borrowing at favorable rates from small banks. That's the story that we are able to see. Now, what we are interested in, perhaps what we should be explaining is, why is it that big banks borrow at favorable rates, small banks are penalized, and the medium-sized banks are in the middle there? What explains this? I think we have about two reasons, but of course, all of them leading to market segmentation. The first one is that from what we see here in terms of lending, it appears to us that large banks have big volume of liquidity. Okay? And because they have big volume of liquidity, they have less need to borrow. And therefore, with this surplus liquidity, they are willing to give it out at what could be. Anyway, the story is that it appears to be the case that they are keen to lend and less keen to borrow. One possible explanation for this is that, of course, what we have seen in Uganda is that majority of these big banks have also got international affiliation. And this international affiliation has been problematic in the sense that these large banks are constrained in their lending to other banks by the credit limits which are imposed onto them by their parent banks. Now, because of these credit limits which are imposed on them, what happens in practice is that they have a subset of banks to which they can lend and a subset of banks to which they cannot lend, which in itself creates some degree of market segmentation. Our prayer is that when we subject this to the actual numbers and the analysis, we see the story being consistent that big banks tend to penalize small banks, and that on average, their borrowing is on favorable rates compared to any other category of banks. Okay, I just wanted to share those few slides. One, just to give a perspective of the structure of the interbank market in Uganda, but of course also to give an overview of where we join in this debate from. Now, with that, in the interest of time, you'll permit me to just jump to the final results that we do get, but the entire discussion of the data, the variables, and then the modeling, it's all in the paper. We can find it there. So permit me to jump to this in the interest of time and be able to complete quite quickly. We find very interesting very interesting results. Of course, consistent with what Victor was alluding to. One of them is that the magnitude of the bankers borrowing in a given period relative to the overall to the overall interbank market demand is a very prominent factor in explaining the interbank market that a particular bank pays. So the more you borrow, the more you pay. So some kind of scenario that banks do not face a perfect elastic demand curve. That was one interesting finding. The other interesting finding is that the size of the banker matters. Smaller banks pay higher rates, large banks pay lower rates. And digging deep in this, the story is very interesting. The idea is that these big banks are seen to be in a comfortable zone. That number one, they have some kind of insurance in the event of liquidity shocks from their parent banks or from their shareholders. But then also importantly, they are viewed by the regulators as too big to fail. So they are always willing to step in. Now, when it comes to this platform of trading, counterparts view them as people who are associated with low default rates. By the way, in coming up with this, we use the vector of financial soundness indicators, a measure of risk and a measure of profitability. And then also using profitability, we construct the Z-score and try to see if we can still get consistent results using a measure of the probability of bank insolvency. And I'm happy to report that results were consistent across the board. Now, the other interesting result is that ownership matters. One, size matters, and two, ownership matters. And that subsidiaries of international banks borrow at lower rates, and so are domestic but big banks. And maybe I say a word about this. What do I mean by and so are domestic but big banks? Until 2017, Uganda had 3 domestic banks. Of the 3 domestic banks, 2 of them were part of the 5 biggest banks in the country by asset size. Now, one of the big banks, domestic, shut down in 2017. But because we are stopping in 2016, Q1, its data set is considered in this analysis. So it's very possible that the big 2, the data for the big 2, had to override the data for the only one small bank over the 3 domestic banks. So ownership matters, and the same explanation applies as was with the size. And 3 is that banks with weaker financial FSI, soundness indicators, and similarly, banks with the lower probability of insolvency. do pay higher rates than their counterparts whose asset quality is seen to be healthy and whose profitability is quite high. So these are the four key factors that we do find in this work that try to explain what exactly determines the interbank rates that Victor alluded to. The details of this is in the paper. I simply had to work within the time. Now, given that there are some questions that Victor posed, I don't remember what they, but there were about 3 of them in terms of peer monitoring, disciplinary, and etc. Now, whether this information package can lend some credence to some of those questions. But what do we say? We see that from the results that interbank markets can exert a degree of prudential discipline in banks. Because you are risky, you will borrow at a penalty. You are viewed as less risky, you will borrow at favorable rates. So that one in itself is enough to insert some degree of discipline. And we think, as per what we have, this is a pretty one reason that the interbank market ought to be promoted and also developed. Because as a regulator, I benefit from that pack of information. Because I'll just be looking at the rates that a particular banker is paying on the interbank, and then I'll be able to tell that this banker warrants some inspection to be able to see what's going on. Number 2 is that banker supervisors can obtain useful information from the interbank markets, which I've just been talking about, that are paid by individual banks, just about the market perception of the counterpart risk of the borrower. So this information can then help to guide risk-based supervision. Of course, this is work ongoing. We still have a few steps to go. We are working on the last paper in this category. And one of the issues we are investigating is whether the interbank market spread conveys information about future deterioration in the FSI of the borrower. In other words, whether this pack of information can act as an early warning of financial distress. And it can help prevent so many things. If we can, based on that information, then we can be able to arrest scenarios before things have happened. And then number 2, which now relates to monetary policy, is that Uganda operates an inflation targeting monetary policy framework. And indeed, the interbank market, which is the short-term interest rate, is the anchor for the term structure of other interest rates in the economy. However, one of the big issues that we are grappling with is the issue of high lending rates. Now, a potential candidate from this kind of work is to investigate whether the interbank transactions that lead to lower risk premium can potentially spill over to low cost of funding charged on the final borrowers. So this is ongoing, and we hope that we can have something very interesting to share. So Victor, I think I'll stop at that.
Oh, thanks so much, Thomas. You provided very detailed insight into how the interbank market operates in Uganda, the role of the Central Bank of Uganda, but also you've given us some very important takeaways from your research. Thank you indeed. We are running short of time, so I will ask the contributors to be, brief. And let me call upon Dr. Jonathan Chipili from the Bank of Zambia Dr. Jonathan Chipili is the chief economist and head of the research department at the Central Bank of Zambia, and has been researching the interbank market in Zambia together with the other colleagues, including Francis Bao and Kosam Chanda, who are here with us. So maybe you can speak briefly, Jonathan, in the interest of time. We still have other other three speakers lined up.
Thank you very much, Prof, and I hope that everyone in the call is fine. Right, as you pointed out, our two colleagues, Francis and Kosam, will reinforce, I think, the discussion during the Q&A. So as you rightly pointed, this paper is on the Global Finance website, so people can refer to it, and it was discussed in September 2019 at the conference in London. So we've since then revised the paper, principally just adding the issue of ownership, which my colleague has spoken about and which you discussed at length. We did include the price differential analysis as part of the analysis of the of establishing whether indeed segmentation exists in the interbank market in Zambia, but we are still refining that aspect. So for the purpose of the discussion today and sharing the results, we're just focusing on two approaches: the network analysis and the trading preference indices. With respect to the network analysis, we focus on exposure metrics, where we want to establish whether the market is complete, incomplete, or incomplete, disconnected. And then we also look at the centrality measures, which look at betweenness, closeness, and cluster coefficient. So in terms of the results, just to go straight to the results, as the paper is focusing on whether segmentation exists in the interbank market in Zambia for obvious reasons, because it has implications on monetary policy. The evidence we have is that with respect to the exposure matrix, is that the interbank market in Zambia is incomplete, but not disjointed. And that banks trade both intra and across different categories. Similar to Uganda, we split banks into three categories based on their balance sheet size relative to the industry, whether they are small, medium, or large. So the evidence we have based on the exposure matrix is that the market is incomplete but not disjointed. That's a key point to take home. And we also note that the clustering coefficient is very close to 1, which means that that banks in Zambia are able to trade amongst themselves, and most counterparties of a bank also have credit lines among themselves. And that all counterparties of some medium-sized banks, which have a global connection, which were identified to be 2 in our setup, are connected. And these banks have fewer number of credit lines in the market, but are connected to dominant counterparties. Further, banks did not alter the trading partners over the sample period, and our sample period was from 2012 to mid-2020. This reflects that most credit lines with previous counterparties were maintained. We also noted that most banks tend to trade with banks they have previously traded on the bank of confidence and trust, which has been established over time. So this tends to help banks to have counterparties they can fall back on in times of need. We have also noted that these results are quite similar to what our colleague has found in the case of Malawi, where sometimes when a commercial bank has a short-term liquidity mismatch, but does not have a credit line with banks with excess liquidity, they resort to use other banks that have mutual credit lines to facilitate the trade. We also noted that large banks are able to trade or interact more amongst themselves fully by utilizing all the credit lines, and this is followed by small banks amongst themselves. The interaction among medium banks or medium-sized banks is very, very weak. So actually among the list of the interaction among banks. So in effect, we are saying that large and small banks interact more amongst themselves more than the medium-sized banks do with the peers. It could be the case that medium-sized banks category is dominated by foreign banks that have the most stringent consideration on credit lines, as their risk allowance is relatively lower than any other bank in the sample. And their involvement in the interbank market space is quite limited on account of their risk consideration. So in terms of trading preference among the three categories of banks, we note that large banks tend to borrow from and lend to medium-sized banks and amongst themselves than they do with the small-sized banks. So the small-sized bank interaction with the medium and large banks appears to be very, very weak. This could be attributed to the strict credit risk compliance rules that large and medium-sized banks follow when dealing with small banks. The consideration for credit lines ranges from ownership of the counterparty bank, associated counterparty default risk, as well as country risk, given that the main form of collateral in our market is treasury bills, which is now a subject of consideration given the rising default risk among Sub-Saharan African countries. We also note that medium-sized banks prefer to trade with large banks than they do with peers and small banks. So meaning that interaction among the medium-sized banks is still weak, but they prefer to deal with small banks and large banks. So what we think could be the reason is that there could be stringent default risk measures among medium-sized banks, particularly those two banks that we've identified of foreign with global connection, such that the preference by small banks is to borrow from medium-sized banks than large banks and their peers. We also note that their lending preference is to the peers. So meaning that risk consideration in this category are more relaxed as peer trading relationships have been built over time. Ownership partially explains the intensive intra-trading within small and large bank categories. The small bank category is dominated by local banks, while the medium and large bank categories are dominated by foreign banks. Most locally owned banks tend to have more trading linkages among peers, and that foreign banks also prefer trading with fellow foreign counterparties. However, intra-category trading among medium banks is the lowest, as I've noted. This is mainly attributed to the diversity of foreign banks in this category. Most of the foreign banks are Pan-African, while others are of global multinationals. So generally, what we've noticed is that global multinational banks have limited, and in some cases, no credit lines with most local banks unless government has a stake. And most Pan-African owned banks, as these are considered as risk counterparties. So therefore, the global multinationals prefer to trade mostly with banks in their large bank category. So in short, the evidence coming from our study.
Sorry, you are muted, Jonathan.
Oh, sorry.
Okay, yeah, thanks, yeah.
Sorry. So in conclusion, our study has established that indeed the interbank market in Zambia is segmented based on those two approaches that we've looked at. And obviously this has implications on the transmission of monetary policy with respect to impact on the real economy. And also the other issue I think that is worth considering in this arrangement, which has been raised in the main paper, is the issue of collateral. Most of the trades in the interbank market in Zambia is collateralized, and the major instrument there is the underlying collateral is treasury bills. So to the extent that now these have come under scrutiny, I think has got significant implications on the function of the market going forward. Whether indeed this collateral is going to be widely accepted and the implication that you have for trading among banks. So I think I'll leave it at that and allow for questions later on. Thank you so much, Prof.
Thank you so much, Jonathan, for covering all those important elements. We see where the Zambian market is slightly different from the Ugandan market, and also where there are also some similarities. So that's helpful. Thanks indeed. I will now proceed and call upon Dr. Sammy Tiriongo, who was at the Central Bank of Kenya on the Monetary Policy Committee, and now with the Kenya Bankers Association. So, Sammy, could you do it in less than 10 minutes, please?
Okay. Well, thank you, and greetings to everyone. And I join Chipili in asking and believing that all of us are well, even during this time of the pandemic. So I'll be very brief in highlighting some of the work that has been done for the case of Kenya, but also, of course, looking at Sub-Saharan Africa through the lens of what has come out of Kenya, maybe to pick out some lessons that can be borrowed. So just in as a small introduction is really to highlight the fact that for Kenya, we are in between an inflation targeting and a quantity targeting kind of monetary policy framework, where now the interbank rate has become kind of a focal point, and that has explained a lot of interest in the interbank market. So with the transition to inflation targeting, the need to have a well-established interbank market is becoming critical day by day. So in light of this, there's been some set of research work, most of which has actually been captured in what Victor presented. But a lot of the work that has been done for the case of Kenya has really focused on the segmentation issues and how segmentation has affected the monetary policy effectiveness. Additional work that has also been done by the Kenya Bankers Association has included how the interbank market picks up signals from other markets, like the government securities market. And what's emerging is that there seems to be a strong connection between the government securities market and the interbank market. And this has a strong bearing on whether monetary policy seems to be strongly influenced by the fiscal policy operations. So it's of great interest that this is highlighted, especially with regard to some of the operations that touch on the fiscal policy measures continue to impact on the interbank market, which is the primary kind of the first step after the monetary policy decisions are taken. So in a nutshell, it's important to understand the diversity and the interconnectedness between the two policies. Maybe just to also highlight some of the salient features about the interbank market in Kenya, which I know previously have been mentioned, but maybe just to highlight a few areas that really require a greater discussion on, is the issue that the market remains predominantly overnight. In as much as it has developed over time, so most of the trades remain predominantly overnight, that's the tenor, and single currency. So again, there is some room for developments in there with regard to deepening further the market. Again, the strong dependence on government deposits and government operations also continue to affect the market in one way or the other, but strongly with regard to periods where there are gridlocks in government expenses. That really affects the liquidity positions for the interbank market. What has also been observed is the asymmetry in the reactions of the interbank market whenever we have different outcomes on the government deposits market. So it's of great interest, again, even as we look into this issue of volatility of the interbank market and the inability of the interbank market to really pick signals from the policy rate, it's also of great importance to really see what are the developments on the other policy fronts, which is the fiscal policy front. The other issue is largely uncollateral. There's no collateral, I mean, for the trades in the interbank market. And with this, of course, there are issues to do with the counterparty risks that emerge quite strongly because of the absence of the collateral. Then the other thing is about the skewed liquidity distribution. Now you find that even with 39 banks participating in the interbank market, you still find perhaps less than a third of these banks holding much of the liquidity that is present in the market. So at any given time, there would be a tendency for mispricing of the same liquidity. And something that was raised earlier is the issue of small banks actually looking like they are the net lenders in the market. And this is because of the counterparty risks that exists in the same market, because then small banks would prefer then to keep liquidity as opposed to lending it to generate economic activity, because again of the risks that exist in the market. So what they would consider as being strong is having a liquidity position that is strong. Of other interest is the participation of the central bank in the interbank market, which I think has been discussed to a limited degree, but I think it's an important issue that needs to come on board, because one is the central bank, in as much as a lender of last resort, what needs to be assessed then is to what degree is it a lender of last resort? Because if the penalties are heavy, then it's more like it's not available as a lender of last resort. But if the penalties are affordable, then it becomes an active source of reprieve for banks that feel heavily curtailed of liquidity in the market. One other thing that we have also observed for the Kenyan interbank market is the limited interactions across the bank tiers, the bank sizes. And this is because, again, of what we would call an entrenched level of segmentation on the basis of size and ownership, which was alluded to by Victor earlier. But one thing that we've also noted that even among the small category of banks, there's still discrimination. So you find large banks lending to small banks at high rates, medium banks lending to small banks at high rates, but even small banks lending to other small banks at high rates. So even in their own room, they still feel that they need to be compensated for the size of the borrower. So one other thing that we have also observed is the incomplete structure. Of course, there are no complete connections between all the banks in the market. And of interest also is the issue that now this is really displayed in the high spreads, because on a single day you can actually find spreads of over 600 basis points within the same market. And this is reflected, you could observe this ideally on a single day, and of course your guess would be as good as mine in terms of saying that the high rates are borne by the small banks. Then the other thing is, of course, of interest to policy makers is the issue that the interbank rate remains highly disjointed from the policy rate, and this is has largely been attributed to the segmentation issues. So the inability of the interbank to pick signals from the policy rate remains a concern for study, and because of this, several proposals have been fronted, some of them we could actually borrow for the case of some of the sub-Saharan markets. It really would matter the issue of improving the market infrastructure in terms of, one, the collateralization process of the interbank market, because one, in as much as Kenya has explored a collateralized interbank market, which we call the horizontal repo market, there will still be issues with the perfection process of collateral, because there were challenges with regards to the transfer of the collateral in the event of a default. So in as much as this was offering an alternative to the interbank market, it really also had its own issues with regards to the transfer of collateral process, which again begs the question that even as we look at improvements on the interbank market for some of the sub-Saharan markets that would have similar challenges, the process of the framework for the collateral involving a collateral in this market would need to be really highlighted and would need to be treated with a lot of caution. Then the other thing is what has been seen in the last 2 years is the issue of the emergence of the strong local banks that now are competing effectively with the foreign banks, which has actually been necessitated by the mergers and acquisitions of small banks. But of great importance is the issue that the participants in these mergers acquisitions are all Pan-African banks. And this is really of great importance, again, at the same time when Kenyan banks are exploring markets in the region. So they're expanding to the region, and therefore they need to really build their capabilities to handle the regional market. So the mergers and acquisitions have created banks that can effectively compete with the foreign banks, and the benefits are really in reducing the spreads within the interbank market, which has been observed in the last 1 year. Of critical concern is also the prospects for mitigating the credit risk, the counterparty risk, which really would look at what is happening in other markets. For instance, the government of Kenya really deployed a credit guarantee scheme to really de-risk the micro enterprises. So if the same approach could also be used for the case of the interbank market, to consider guarantees for participants that are deemed to be risky, that is also something that can help in developing our interbank markets. Of interest, as I mentioned earlier, is the participation of the central bank in the interbank market, which can actually also help in developing our interbank markets. One is through reducing the stigma with the use of the measure of last resort kind of window that's available at the central bank. Again, if it is too punitive, as I mentioned, it really derails the same purpose for which it is supposed to serve. And if there were adjustments on the availability of liquidity, in a sense that liquidity would be made available, of course, as a measure of last resort, but at the same time, it shouldn't be too punitive, again, to strengthen the counterparty risk considerations that are currently present in the interbank market. The other consideration is the issue of, as banks expand to the region, now we do not only talk about contagion risks within the same financial system, but now in a regional perspective. So strengthening the surveillance systems and the interconnectedness of markets, like for instance, Uganda borders Kenya and Kenyan banks are in Uganda. So the need to really collaborate at that level of surveillance is important. And this has the ultimate benefit of really reducing the counterparty risks for banks in each of the local interbank markets. I'll make mention of two things that of recent concern is the issue of the market disciplining mechanism, which really involved the work that we did in published by the ESRC in 2019, and this involved Kenyan market and the Malawi market, and we found that there is potential for the interbank markets to really support the prudential regulation that the markets have, because we saw that from the quantity based, when banks are participating in the interbank market, whenever there is a risk consideration, then banks would either be denied volumes of liquidity, or they would actually be charged higher rates. But we found this, the actions of being denied access to funds and the actions of being penalized with higher rates actually amount to banks being able to now build up their buffers, capital buffers. So it kind of disciplines them to the extent that whenever a bank is denied access to funds, or whenever it's charged higher funds, there is an incentive for it to build capital buffers.
Sammy, we are running short of time, Sammy.
Yes,
I hate to interrupt you, but we are running short of time.
Yes, I'm concluding actually. 2 minutes.
Thanks. Yeah.
Yes, so there is evidence of market disciplining mechanisms in our markets to that extent that whenever a bank is penalized with less volumes or higher rates, then they build buffers, of course, with a lag. The other components of research that we're doing now include now the network mechanism that exists in the market, of course, with a broader objective of understanding the contagion within the same market. Of course, this would have the benefit of really helping policymakers to also know the points of interventions, so that should there be a shock in the market, at what point should it be intervened? Identifying the banks that are money centers, identifying banks that are strongly positioned in the market to really transition the risks. So this is ongoing work, and again, I think I'll be making them available as and when they actually become ready. So again, thanks for the opportunity. Thank you.
Thanks so much, Samuel, for very insightful coverage of the interbank market in Kenya. I know you could speak about this for a whole day, and I hate to disrupt you given the experience you have, but I was running short of time. But very, very key, distinct features of the market compared to what we've had from Uganda and Zambia. So I'll now call upon Esmie. Esmie, I'm sorry, I have to be very strict, and I give you very short time. Maybe if you could summarize in 5 minutes, that would be much appreciated. Esmie.
Thank you so much, Prof. And good afternoon, everyone. In a space of 5 minutes, let me see what I can do. Yeah, I'll talk about the interbank market in Malawi. There are some facts on the screen. It's a small market, but it's still growing, and there's no cross-border trades, and the trading is always in local currency, and no regulation. The market has been growing in terms of the traded volume over time, and we've noted introduction of market tracker in 2018. This has improved price discovery, because every bank is now able to see who has traded with which bank and at what rate. And we've also seen an increase in central banks' reliance on this market since 2014. This is because we have now started using the interbank market rate as an operation target for monetary policy. This is a movement from using reserve money. I just want to give you just a taste of the research which I'm doing. Basically, I'm trying to answer 3 of the questions that Professor Murinde mentioned. The determination of access to interbank markets and determination of pricing. And in addition to that, I'm also looking at what determines lending, what determines the ability of a bank to lend in the interbank market. And I'm using high quality data. This data is not publicly found, and it covers all the banks that are operating in Malawi in terms of the interbank trades and rates for for the period 2010 to 2018, and also the bank characteristics of size, risk, capitalization, profitability, and liquidity. So I should mention that one of the reasons why I had to do this research is something which is interesting that comes up is that in Malawi, although the interbank market may have enough liquidity, but sometimes you see banks still coming on the discount window to borrow from the central bank at the punitive rate. So this created some sort of curiosity. I also noted that much as some banks have been, all the banks have been net lenders or net borrowers at a certain point in time, as you can see from the chart there. All the banks, almost every bank is a net lender or a net borrower at a certain point in time, but there have been banks which have been net lenders most of the times, while others have been net borrowers most of the times. And there's also, there are differences in the amount that banks have been paying when borrowing from the interbank market over time. So some of the preliminary findings of my research are that we find that counterparty risk plays a key role in the determination of both access and pricing of liquidity in the Malawi interbank market. Specifically, I found that more risky banks borrow less from this market, but also they pay high rates when borrowing from this market. And we also, I've also come up with the truth that more liquid banks are net lenders. Unlike the case of Uganda, as Dr. Bwire said, that big banks are net lenders. In Malawi, it depends on the liquidity, liquidity of the banks. And banks which are more liquid also pay lower prices, and they also borrow less amount from this market. And there are also other factors affecting differences in access and pricing. Such factors include capital adequacy, profitability, bank size, and bank ownership. It's very exciting. The way I'm measuring these variables, it's a bit different from what is existing in literature. And in terms of the second stage, monetary policy, my preliminary findings, I saw that there are differences in growth of loan supply and lending rates amongst banks. The upper chart is showing growth in loan supply for individual banks over time. We know there's a difference. And also in terms of the rates that banks charge when providing loans to their customers, the diversities among the banks. So would this be explained by what is happening in the interbank market? So the answer is yes, because I found that banks with access to the interbank market expand credit to their customers faster than those with no access to this market. And I also found that banks pass interbank market borrowing costs to their customers when extending credit to them. So banks which borrow at a higher rate in the interbank market, they also charge higher rates when extending credit to their customers, while those that are accessing liquidity at lower rates also charge lower rates to their customers. So this confirms the presence of a transmission mechanism in the Malawi interbank market. And my next stage, I'll be looking at now the ability of the interbank market to mitigate risk in the banking sector in Malawi. So in 5 minutes, this is what I had to say. Thank you so much, and thank you, everybody.
Thanks very much, Esmie. You provided very, very important critical points of understanding the Malawian market and how it's different, and all similarities as well with the other markets, and for the discipline of keeping your presentation short, precise, and also point to future research. Okay, I'll call upon the last speaker, Anosi Ikimalo. And again, Anosi, please keep it to 5 minutes maximum.
Thank you very much, Victor. I'm glad to speak to this audience. So to go through quickly some of the work that we're currently doing and the research areas that we've identified. First of all, drawing on the theme that has been recurring through, as we listen to all the speakers, about segmentation in the market, on how certain banks, like large banks, tend to charge a premium to small banks, and even interestingly, small banks also charging a premium to other small banks. This invokes some of the research that we're doing in terms of examining how market power of the banks actually affects the way they trade in the market, affects how they charge for liquidity, and how this may possibly impact the smooth functioning of the interbank market. Another dimension of research that is interesting that we're looking at is the role of trust. As Professor Victor mentioned in the paper that they, in investigations that they had previously done, and how bank size plays a major role in examining the contagious effect in the interbank market. Perhaps these factors could be extended beyond size, and we could also look at the relationship or the trust sort of factor, and how that may affect either positively or negatively the contagious effect when a financial shock is applied to the system. This will be done through a simulative study. Another dimension that we are also looking at is the role of governance in terms of the CEOs of these banks, and how these the networks amongst the CEOs may affect the network of the banks themselves in the interbank market, and how they trade amongst it.
Sorry, you are freezing. You've frozen, Anosi. Hello? Ameng?
Yeah, I think he's disconnected. Maybe his internet is.
It seems we have lost. Okay, thank you. Yeah.
Hello?
Yes, you are back now.
Okay, yeah. So looking at the current trend in the Sub-Saharan African space, where there is a rise in regional banks, and also to the dominance of foreign banks in some markets, a radically new approach to examining the interbank market, from moving from more of a horizontal approach to a three-dimensional approach, where we examine the spillover effects of the activities of banks in one market affecting the other banks, their subsidiaries or their affiliates in another market, particularly amongst the regional banks, also poses a very interesting dimension of research that we're beginning to think about. Finally, another area of further research would be how to incorporate the information that we can derive from the interbank network into understanding or into examining the risk, riskiness of banks, perhaps by incorporating it into the Z-score or S-score used in classifying systematically important banks. Yeah.
Thank you very much.
Briefly, in 5 minutes.
Thank you very much, Anosi.
That's a summary.
Anosi is a researcher in the Center for Global Finance at SOAS, and he's looked into future directions for this work. I like all these future direction, trust, governance, and information. In fact, the last one, information, could be generated from machine learning algorithms to produce extra data. I'm sorry, we are running short of time, but I'd like to I would understand if some colleagues want to leave because we've reached the end of the, but I'd like to encourage those that can hang on for at least 5-10 minutes so that we can take comments. I don't see any comments in the chats. Meng, could you look at the chats? And I don't see any hand up, but let me see whether there are people.
have some comments from Richard.
Oh, yeah.
Yeah.
Richard, please go ahead.
Or
has he left?
Yeah, maybe I think Richard has.
Okay. Any hand? I can see there is a hand. Yeah. Please go ahead. Yeah.
Okay. My comment was in relation to an early point that Victor made about the interbank market and the issues surrounding the freezing of the interbank market around the global financial crisis. And in fact, the first UK bank to crash during the global financial crisis, Northern Rock, crashed not because of bad lending practices, but because they relied on the interbank market for their business model, and that then dried up. And I wondered if there'd been similar instances in Sub-Saharan Africa.
Yeah. Thank you. Yeah, I think you are right. Richard, it's the interbank market picking up some of those vibes. The peer mechanism and information sharing is particularly important. For banks in the interbank market, as well as banks which don't participate in the interbank market, but are core borrowers or lenders with banks in the interbank market. I can see two hands up, one from Dr. Andrew Mwaba, who is on the board of directors of the Bank of Zambia, and also from Sandra, who is Dr. Sandra Kendall, a researcher at Esmie University, and also Dr. Louise Peter Rose, the former Minister of Finance of Seychelles. So I'll take comments from Dr. Andrew Mwaba, and then Dr. Sandra Kendall, and Dr. Peter Rose. So, Andrew.
Yeah, no, thank you, Victor. And let me thank the presenters for these very useful presentations. I've seen that a common thread running through the various experiences is the issue of liquidity of the interbank market. What have you seen as determining the differences, in these? Is it monetary policy or is it a government fiscal policy? Just what's driving these differences? Thank you.
Yeah, thanks very much, Andrew. About the liquidity, I think various central banks have commented on this question of liquidity. But it appears that it depends on which type of banks and at which levels, at which sizes that can get steady flows. And liquidity fluctuation in the market are expected, and that's how they when liquidity clears, that's the volume. Then of course prices are formed, and that's the interest rates. So those variations are particularly important. We could do a further determinants of liquidity question. It is an empirical question we could subject, and so thanks for that, much appreciated. I will possibly go back to speakers after here. Sandra.
Okay, thank you, and thank you for all the different presentations. And for my concern, I have just maybe a question about the credit access, because you have also developed the side of the access, the large banks that are just granting credit to small banks. So I have maybe in this aspect, I have two questions. In your sample, when you were just developing the analysis around the interbank market, are you considering in your sample the commercial bank, to be more specific about the type of bank, commercial bank and microfinance bank, or maybe you see, because for my concern, my question is how the interbank market are just ease the financial integration of microfinance. because we have these borrowing aspects that you have mentioned. And it is also, I mean, it is an important part of the development of the microfinance institution in general. The more they can get access to those borrowings from banks, those banks, and maybe the better they can also easily develop their different activities. So is there any facilities that they can just beneficiate? I mean here the microfinance banks, or maybe the microfinance institutions. Is there any facilities that they can just that we can just have in the interbank market that is the financial integration of the microfinance institution in the banking sector? And maybe if there is any discrimination about the access, because I hear about one presentation that was mentioning the fact that, I think it is the Kenyan case, that mentioned the fact that large banks, they usually grant more credit, but for the small banks, when they just grant the credit, they apply some high interest rate. So there is a kind of discrimination also in the access for small banks. So maybe do we observe also such kind of discrimination for the microfinance one, or maybe we can just split and diversify the analysis around the aspect of credit access for microfinance?
Thank you, Sandra. That's a very, very important question. Not only for just policy, but I think for empirical investigation. I recall that there was mention specifically by Sammy Tiriongo on picking signals from other markets. There was also that question also, Anosi, on other. The participation in the interbank market is by commercial banks, okay? And other strictly microfinance institutions, which are not commercial banks, only may impact on the interbank market by virtue of working through the banks that participate in the interbank market. And that's why I think almost all the commentators, but in particular, I remember Samir making that point that we need the interbank market need to pick signals from other markets and financial institutions, and that could be including of signals from the microfinance institutions. I will call up and give a round to the main commentators. Please keep this in mind. I can see Thomas already available with an answer, but let me take one further comment, and then we'll open and get some further input. Yeah. Okay, Peter. Dr. Peter Rose, are you there? You are muted, I think. Hello? I think.
Hello.
Yes, please go ahead.
Thank you, Professor, and thank you for the presenters for the very comprehensive research. But then we've been discussing the research we had taken back a few years, but this is a preoccupation. Now that the government, whether in Sub-Saharan Africa, all over the world, are trying to inject capital to save economy. And in fact, I would ask, how does this inflow of capital affects the interbank market, or whether it is a complementary situation? I'm sure there must be a profound effect on that. Thank you.
Thank you very much, Pierre. That's a very, very important question. And I know that one of our researchers at Center for Global Finance, Timothy Zokulu, might also be kicking in to answer that question. Or it's that we regard the interbank market as one potential avenue that can really reboot economies that are struggling with the global financial crisis, provide a mechanism of a financing mechanism of injection, which makes flow of funds possible. And that would be my take. And now, in terms of parameters and evidence, we don't have evidence, but this can be easily simulated on how the injection through the interbank market can be able to support banks and then the sectors they finance. I think that's a highly plausible answer. Now, in the interest of time, I just call upon our distinguished speakers to respond to one of the questions from Dr. Mwaba, from Dr. Sandra Kendo, or from Dr. Rose. So let me give each about 2 minutes if they want. So Dr. Thomas Bwire, 2 minutes. 2 minutes or 1 minute. Do you want to respond to any of these questions?
Not really, because
Okay.
you have done a very good job representing almost all of us. No, it's a good professor in the room.
Yeah.
But I just wanted to maybe just shed some light on the question of microfinance. Why when we talk about interbank, we are concerned with commercial banks and not microfinance. In the operations of the central bank, we categorize financial institutions in terms of tiers, and some of those are regulated by the central bank and some are not. Now, for a case of Uganda, microfinance are not among those institutions that are under the regulation of the central bank, but they are regulated by somebody else in the system. So that's why the concentration here is on the commercial banks, and nothing is mentioned of the microfinance institutions. Possibly in the future, as we expand our arm of control, we may have to, to expand this if that information is available. But as of now, they have to be out and protected.
Thank you very much.
Yeah.
Thank you very much, Thomas. Maybe Francis or Kosam or Jonathan, if you want to come back, if you have any response to any of the 3 questions mentioned. So Francis or Kosam, you may speak, or Jonathan, if you want to come again.
Yes, I don't know, Francis, if you want to speak, I can respond. That's fine with me.
Okay, thanks,
yeah,
Jonathan.
Yeah, sure. Yeah, whether this also, I think this also ties into the issue of broadly, I think, accommodative monetary policy currently prevailing in the market, which was raised by Peter, if I got the question right. I think for me, there's no liquidity constraint where I see the evidence that I have from the various markets in Sub-Saharan African countries. I think the key point is trust, the point that you raised, Professor, in your presentation, because this is what governs the market. Trust, which borders on a credit risk. Can you appropriately assess this credit risk and trust the counterparty? I think that's the key point. The issue of capital flows coming through the market, which reinforces the accommodative monetary policy, is supposed to be complementary in terms of the transmission of monetary policy and its impact on the real economy. Thank you.
Thank you very much, Jonathan. Esmie, if you want to say something, or you may, Esmie.
Yes, thank you, Prof. I want to respond to the question of liquidity. What determines liquidity of banks? Generally, it's to do with the business models of individual banks. It's the priority. It's to do with profitability versus risk. How the bank wants to do with the deposits. Do they just keep them, or they want to extend as more loans as possible? At the same time, there is also an issue of meeting central bank requirements of liquidity. So there's a minimum level of liquidity that the central bank looks for in every bank. So it all depends on the balancing of the bank and also the ability of the bank to forecast liquidity for a particular day. Their business, their forecasting framework. Are they able to forecast to reduce errors in the forecasting the amount of liquidity they want to keep? And also on the question of how the pandemic will affect interbank markets, I'm thinking there's also a potential in research to see how the pandemic is affecting the riskiness of different banks. This is to do with which sector does each and every bank lends to most, and which sectors are affected, and which sectors are doing fine in this pandemic, and how do that affect now the riskiness of each and individual banks. Thank you.
Thank you very much, Esmie. Absolutely very helpful comments, and thank you for going into not only the forecasting, but also for the business models. Yeah, much appreciated. Anosi, do you want to add anything in 1 minute?
Yes, I was just going to say that the comment from the gentleman from Kenyan Central Bank about you know, the segmentation and seeing even small banks lending to small banks is actually quite interesting, because perhaps that shows that the size may not necessarily be the issue, but there may be other factors that drive the decision of the rate at which banks lend to each other, or at which banks charge for liquidity.
Thank you, thank you, thank you. And finally, Sammy, to give you a chance, if you want to respond to any of the 3 questions, or give come again. Yeah, just 1 minute maybe.
Yeah, I think there was a question about the link between financial markets, and particularly the link between government operations and interbank market. And it's important, it's good that this was raised, because it may not be the case in other markets. The case of Kenya, the central bank is a sole bank to government. So all tax collections and all collections by government are banked with the central bank. So to a large extent, the spending behavior of government affects the liquidity positions of banks. And because of that, then the operations of government affect the interbank operations. So the signals come from government operations to interbank. So in a nutshell, what you're saying at the end of the day then is, it depends on how the structure of each of the financial markets would be, and even how the financial institutions are linked to the banks, either in terms of provision of liquidity, or also in terms of their own risk characteristics at the end of the day. So to a large extent, the operations of the government for markets that are structured such as Kenya's would really be very important for the interbank market. Thank you.
Thank you very much, Samuel. Yeah, I'm sorry, we have to stop here. We're already overrunning by. Hello. We're already overrunning by a couple of minutes. I want to thank you so much for being able to come to this seminar and contribute generously to the exchange of ideas. We'll continue this research with their partners, and maybe welcome you as a new researcher into this dimension of research into interbank markets. And let's keep in touch, and thank you very much. Thank you indeed. Okay, I want to thank all those speakers who have been generous with their time. In particular, Esmie Kanyumbu from the Reserve Bank of Malawi, Dr. Thomas Bwire from Bank of Uganda and COMESA Monetary Institute, Dr. Sammy Tiriongo from Central Bank of Kenya and the Kenya Bankers Association, and Dr. Jonathan Chipili, as well as Dr. Francis Mbao, Dr. Kasim Chanda from the Bank of Zambia. Thank you very much for sharing with us this great research you are doing on the African continent. We hope that it will excite further research in many other central banks not represented here, who are looking to be into investigations into the interbank market in Sub-Saharan Africa. Thank you very much, and bye-bye. We'll see you next week. Thank you. Thank you indeed.
Thank you.